Thank you very much. My name's David Blanchflower. I've got all these titles, and I don't quite know who that is, but it's me. I am Professor of Economics here. For my sins, I was a member of the Monetary Policy Committee at the Bank of England for a 3-year period where we went through financial meltdown. And what we're going to do today is we're going to talk about, as you see the title, where does the US economy go from here? I'm going to talk for 5 or 10 minutes, show you a couple of videos and sort of set the scene. Then I'm going to introduce our guests, and each of them are going to talk for a few moments, just set the scene, and then I'm going to ask a few questions and then open it to Q&A. I think of the background to this crisis that we've seen is that this is really once in a 100-year financial event. It's a shock that hit the world, and in many ways, for lots of people, it was actually quite unexpected. It actually started in the US housing market in 2006, and then it spread to consumer confidence and to actually the labor market. And I'm a labor economist, and I hear people say things like the labor market's a lagging indicator. Well, actually, in this recession, the labor market led, and then output started to fall. And what was interesting was that pattern, and then we say we got output dropping in about April 2008. Interestingly, exactly the same pattern actually occurred in most other countries. So in the UK, just as the pattern did in the US, it started in the housing market, moved to consumer confidence, then moved to the labor market, and then moved to output. And in many senses, it was a unique crisis in that most economists and most central banks actually missed it, and they didn't call it well enough, and to many it was a shock. The background I think I want to just give you today is just to think about the scale of the shock. Because if you ask the question, where's the economy going to go from here? In some sense, you have to understand what the scale of the shock was, who it hit, before you can really value where are we going from here? Is this thing all over? And in many senses, we're going to argue today about, I suspect, the counterfactual. What would things have been like if the authorities hadn't acted in the way that they did? So I'm just going to set the scene with a few little slides and just show you a couple of things that I think are relevant here. So the first is, this is just to get a sense of the scale of the shock and what would have happened if the authorities hadn't intervened. And I thought I'd just play you 2 really quick clips. And this is a clip from 60 Minutes of the Chairman Bernanke was asked roughly the question that I've just said to you. What would have happened if the authorities hadn't intervened? What was the, if you like, the counterfactual? And let's just, hopefully this will play.
If the Fed hadn't acted, what would unemployment be today?
Unemployment would be much, much higher. It might be something like it was in the Depression, 25%. We saw what happened when 1 or 2 large financial firms came close to failure or to failure. Imagine if 10 or 12 or 15 firms had failed, which is where we almost were in the fall of 2008. It would have brought down the entire global financial system, and it would have had enormous implications, very long-lasting implications, for the global economy, not just the U.S. economy.
Okay, so that's the first thing. You can see there's a fuller interview. You can see it on the Fed website. So Bernanke's position is that if the authorities hadn't acted, hadn't saved the banks, hadn't cut interest rates very close to zero, and done quantitative easing, unemployment, particularly talked about in the US, would have been 25%. We actually, Tom Keene and I this morning, we interviewed Alan Blinder, and I asked him roughly the same question. And he said in work that he'd done, his view was perhaps 25% was too high. It was maybe 16%, but we both agreed that still 16% was horrible. Maybe a quibble about whether it's 25 or whether it's 16, but the answer is pretty darn large. So I thought I'd also show you another little interview that I actually did with Alistair Darling. And Alistair Darling was the Chancellor of the Exchequer in the UK, the exact equivalent of Poulsen here. Darling was actually responsible for rescuing RBS, rescuing Lloyds, Northern Rock, and actually not allowing Barclays to purchase Lehman's. And I asked him this question, because he was my boss for years, and I've been dying to ask him this question. So I asked him, how close to Armageddon did the world come?
About how bad things were in the autumn of 2008. You as Chancellor had to rescue Northern Rock, RBS, Lloyds. How close do you think we actually came to global financial meltdown, and how much has that dissipated now? Is it just gone away? How close were we to real meltdown?
I think we came within hours of a collapse of the banking system. Remember, RBS was one of the biggest banks in the world, and we had a situation where it was going to struggle to get through a day. So we had to take action. Now, we did take action, and at the time we committed billions of pounds to stabilising the banking system, and people were, people said, taking a real risk, you'll never get your money back. Well, it's rather obvious now we are going to get our money back.
Right, so just say that again. He said if we hadn't saved RBS in the morning, they were going to fail in the afternoon. I've talked to him subsequently. His view was that probably cash machines around the world would have closed that afternoon. So that's how close we were. And the question is that all over? Well, a shock of that kind perhaps is rather unlikely that the whole thing is all over. I just want to show you a couple of little charts here, which actually I think are relevant to the position of the US. So this is data across countries. You can just eyeball it as you go. And it certainly looks like this event probably isn't over. Let's just have a little look here. So what we have is the scale of the shock in output terms in the middle column. So the US output fell about 3.8 from the start of the recession to 2009 Q3, and output picked up subsequently. The US, it turns out, has a very large employment shock. It has a very large drop in employment, much larger drop in employment than virtually, for a scale of the output shock, a much larger scale of employment drop than other countries do. And countries like the UK, which has had not far off double the scale of the output drop, have not seen an employment drop of anything like this amount. And I was at the Fed a little while ago. A bunch of labor economists went there actually to talk about why it was that the US had done so badly in employment terms. One possibility, of course, is that the US has shaken the labor market out. It's made the adjustment at the beginning, and all will be well from here. Alan Kruger, who actually we're going to talk to tomorrow, his view is actually that, and Bruce will probably talk about this, his view is that American employers sort of panicked and got rid of workers too quickly. But we need a story why it is that the US, in comparison to its scale of output drop, has actually had a really big employment drop. So if we look at countries like, I don't know, let's look at the Netherlands, where you have a comparable output drop over the time period and no drop in employment, and the pattern across countries is certainly not finished yet. So the worry is that even if we say perhaps that the US, it's all over here, it may not be all over everywhere else, and the pattern in the output data is rather different country by country. Just a little background to where we go from here. I thought I should just show you, can you not see it? Sorry, folks. I thought I should just show you, just as a start, where we are and what the Fed actually thinks we're up to. And I think it's a good background for us. So this is the forecast out this week by the Fed. And this is really the central things that macro policy makers care about. It's core inflation, it's the unemployment rate, and the change in real GDP. This is probably quite a strong forecast. This is essentially you take out the lowest three and the highest three, and you say, what do you think is going to happen to GDP? And GDP growth looks relatively strong. It doesn't look that unemployment is going to come down that quickly. But I think the bottom line I want to give you from this table is actually that despite all of that and despite all the worries that we talk about, the Fed doesn't see really any much inflation at all. And we're going to talk a bit more about that, I assume, in the questions. And I'm going to leave you with one little slide that I thought I would like to show you, which is people say that it's all over, and people say we can we can cut the stimulus right now. And I thought I would just show you this cartoon. And it dates, if you see top left, it dates January the 5th, 1938. And essentially this view is what was called the Treasury view in the 1930s. And the view was, don't worry, we can cut public spending, all will be just fine. And the Prime Minister's looking out of the top window. There's the Downing Street Temple of Sunshine, and the forecasters say, don't worry, the weather's going to be fine forever, set fair indefinitely. But if you look at the bottom, it says the fellow ought to be ashamed, encouraging rain. The umbrella says anti-slump precautions, and it's Keynes. And some of us were at the Bretton Woods 2 weeks ago or so talking about the second Bretton Woods. I think this is a good moment for me to stop because most people don't notice in the top left-hand corner the clouds are gathering. Can we? That's it. Thank you. So now, thank you. So now if the panel can come forward. So distinguished panel that we have with us, and we thank them very much for coming. They've been very gracious teaching class and talking a lot to the students, and the focus of it has actually been to do that, so I'm really grateful to them. Let me just introduce folks, and we're going to start at the far end, Neil Irwin from the Washington Post, Tom Keene, editor-at-large at Bloomberg, Samuelson from the Washington Post, and our own Bruce Rauner. I think what we would like to do is actually start with people and just talk for 5 or 6 minutes about what your thoughts are, and then we'll go to questions. And I think the simplest is to start with Neil and work along the panel, please. Well, you can do it.
Thanks very much. The topic that we're looking at is the U.S. economy and what lies ahead. So to start, I'll look into the very immediate past, which is the beginning of this year. And I'll be honest, as we entered 2011, I was feeling a little bit optimistic about things. We had a combination of, we made it through that slump in the middle of last year in which there were a couple of weak quarters and the jobs numbers seemed to be turning the other direction. We had a new round of monetary easing out of the Federal Reserve hitting the system, the quantitative easing, the QE2 program. We had a payroll tax cut that people hadn't really expected, so there was a boost on the fiscal side from the U.S. government. And, all the forecasters were kind of upgrading their expectations. A few were thinking, hey, we might grow 4% this year. Maybe not fantastic, but that's something. And then January actually came around, and then we didn't. Things kept happening, and we're in this recovery where whenever there's a few nasty snowstorms in some major cities, or price of oil rises $20 a barrel, or you have some of these hard to predict kind of weird shocks. Suddenly we ended up at a 1.8% growth rate in the first quarter, which is pretty mediocre. And I think what it tells you is something about the underlying strength of this recovery. Even with all this boost we're having from monetary stimulus, from fiscal stimulus, we're on a very soft growth path where any little thing can come along and kind of knock us off of it. And in one sense, it's surprising because we're used to recovering rapidly from recessions in this country. On the other hand, it probably shouldn't be too shocking. And the reason is, if you look at Carmen Reinhardt and Ken Rogoff's work on financial crises, if you look at any kind of historical record, economies that are recovering from a financial crisis are just different, are fundamentally different from what happens in the wake of conventional recessions. And you have all these negative forces that are working over time against recovery, and it takes a long time to recover from that. So you have this debt overhang that we're dealing with. Now, what's happened in the last couple of years is huge private debts have been essentially substituted with huge public debts, but we still have a huge debt burden that we have to work through, and households are still paying off credit card bills, trying to get out of mortgages they can't afford. There's still foreclosures. There's still people underwater on their mortgages. So that's a perpetual drain on growth for another few years. At the same time, the factors that would normally come into play to boost growth, monetary easing, it's kind of the pedal's already to the metal there. And it's not like the Fed can do a lot more. Paul Krugman might disagree, but it's not within the range of things that are really on the table. It's not clear there's a lot more the Fed can do. You can have arguments about fiscal policy, but what's certainly clear is there's no political appetite for more fiscal easing. And I would add it's not even entirely clear that those things would move the dial in a measurable way on growth anyway. We're in this situation where ultimately we must delever, and it has to happen eventually, and we can't run 10% deficits year after year for the end of time. Eventually, the bond market won't let us, and finding a path out of that is going to be very hard, and that's the task before our political leaders now is trying to chart a course and thread the needle and find a way to reduce this debt burden over time in ways that don't undermine the recovery. One thing I would add is that it's made more complicated by the fact that the Fed is at the zero lower bound. Normally, if there were fiscal tightening that caused a drop in economic growth, the Fed could kind of counteract that sum by cutting rates. Well, they've had their target rate at zero since 2008. They already have a $3 trillion balance sheet. There's not a lot of appetite in the Fed to do more. And you have an inflation problem, and you have commodities rising. Even if overall inflation isn't much of a risk, even if wages aren't rising, it's still hard to do more if you're the Fed when you see oil prices rising 20% a year. So we're in a rough spot, and it's going to be a challenging decade. That said, I think we have a situation where There's a lot to build on in a vibrant industrial sector. There is a rebalancing happening. The good news is that households are delevering. They are paying down debts. The dollar's down. Exporters are becoming more competitive. So there are some glimmers of hope, but it's rough. It's going to be a rough few years.
He said it all. I don't have to say anything. There's so many ways to go here, and since one of our best analysts of inflation is sitting to my right, I'm going to take a more philosophical view. Where are we? Where are we heading? One story, I came in at the crack of 4 a.m. on an August, I believe Wednesday or Thursday, coming up on 4 years ago, looked at what's called LIBOR OIS and the TED spread and set up profanity, speed dialed our London office, where the guy on the other end of the line said the exact same profanity. And that was sort of the beginning of the crisis. We had a 4 standard deviation move in TED spread, LIBOR OIS in a matter of minutes, and we were off to the races. And so where do we go from here is also very much part behavioral, and that this is getting long. We've been doing this longer. For example, in wars, we like to compartmentalize maybe 4, maybe 5 years across our history of what's the appropriate time for a war. Maybe we do that with crises too, and this is just getting a little long. And what I'm really looking for in terms of where do we go from here for 11 and 12, and we can talk about all the different economics and this, that, and the other thing, is a lot of people are really falling off the rolls now. They've run through their savings. We've got a, depending who you talk to, 7, 8, 10 million employee deficit. If you take and extrapolate forward, and I urge you to do this, take a semi-log chart of any of the major series, and as Mervyn King would say, look at the level, not year over year or month over month, and you extrapolate out how we felt 4 years ago, we're getting farther and farther away from that good feeling that we had. And the phrase that I'm seeing percolate up to look forward to in terms of where are we going here is the phrase Gilded Age. Jim Grant's just putting it out with a book looking back at the actual Gilded Age, the 1890s, but it's coming up more and more. And Danny and I talked to Alan Blinder about this today. Is this a Gilded Age? And you get a lot of different opinions on this. What I don't hear is much discussion about the theory of trickle-down. I don't know what we're trickling down now, but it's not stimulus because maybe that was simply a pull forward of future quarters' efforts, whatever the theme was. But I think the basic idea is behaviorally is everybody's getting tired of this. The single best chart I've seen of this is Mark Zandi, moody'seconomy.com, which shows the basic MSAs across the country, and he takes pi r squared and he puts a circle up of economic development. I'll cut to the summary. New York, Washington, sort of kind of like San Francisco, and that's about it. And the number one thing we learn at Bloomberg every day is our reporters talk differently and act differently once they get on an airplane and go someplace else. Or frankly, once they get in a car and go anywhere like 40 or 60 or 80 miles away from New York City. I think everybody in this room is much better at this than the princes are sitting in New York City. But behaviorally, and the debate economically to 2012, to the election and to the heat of it, a shameless plug. GOP debate, October, here, with Charlie Rose. Charlie Rose is doing it. That was a good shameless plug, thank you. But the idea here of Gilded Age is something I think to focus on, the idea of plutocracy and of income distribution and that political debate and the fear that that brings up. And I would go again back to Bob's wonderful study, important study of the early 60s and into the 70s, or back to, there's a guy here, Irwin, who's pretty good. He's like, okay. He's in the cheap seats under the Dunkin' Donuts sign. But anyways, Doug Irwin, I mean, look at his new book. I mean, everybody's like, I've studied so hard, I got to get to finals in June. But study the Depression and the debate over it, and I really wonder, it's not a depression, but this idea of Gilded Age, if that's the economic debate to come here, is everybody gets a little bit tired.
Just an aside, Willem Deuter called the LIBOR don't lend to each other.
I'm reminded, of course, of what I think is Yogi Berra's famous saying about predicting. Predicting is difficult, especially the future. I think he said it. In any case, that's been my experience over the years, and that's usually why I try to stay away from predictions. I think I'm a little bit more optimistic than either Neil or Tom, but I have a heavy overlay of uncertainty and confusion. Why do we have recessions? Why do we have business slumps? Basically, the explanation is that something in the economic system goes to excess and has to be cut back. And whether or not the cutback is mild or it leads to a kind of chain reaction, as it did in this case, of other cutbacks that feed on themselves, really depends on, determines how deep and severe the downturn is, and of course also how quickly and how appropriately the government might respond to it. In this case, I think the imbalances that developed in the economy were huge, and until they were exposed, they were generally unappreciated or underappreciated. Having said that, I think that things are beginning to reach better balance in a lot of the markets that drag the economy down. So let me just give you a couple of examples. First, consumer spending. Now, consumer spending constitutes roughly 70% of the economy. In the early 1980s, it constituted something over, slightly over 60% of the economy. What happened between the mid-'80s and, say, 2006 or 2007 is that we had a huge boom in asset prices, stock market prices, and housing prices that were driven fundamentally by the disinflation that occurred at the beginning of the 1980s when Paul Volcker and Ronald Reagan crushed double-digit inflation. And as inflation came down, both nominal and real interest rates came down, and asset prices went up. The stock market, if you will recall, the average of the Dow Jones Industrial Average in 1982 was less than 1,000. And as people felt richer, because they were richer, their stock portfolios had gone up, and later their housing values went up, they began to spend more of their current income, and they began to borrow more, both against their house, the accumulated equity in their house, and just against their general wealth. And so we had a consumption boom during this entire 25-year period that was essential to driving the economy forward. And consumer spending as a share of total GDP or the economy went, as I said, from the low 60s to roughly 70. Well, we have now had a reaction to that in many ways, and the personal savings rate over this period went from roughly 10% down to a little bit more than 1%, I think, in 2005. This was fine as long as the asset prices stayed up, but as we discovered, a lot of those asset prices were bubbles. And when they collapsed, people understandably got terrified, and they began saving more and spending less. And that helped drag the economy down, and it fed on itself in many ways, including higher unemployment. But this is now beginning to reverse. The savings rate, the personal savings rate, which is the proportion of your after-tax income that is saved in the aggregate across the economy, has gone from about 1% to in the range of 5 to 6%. So a huge adjustment has occurred there, and that means now it could go to 10%, hell, it could go to 15%, nobody really knows. But my gut tells me that if it continues to move up, it will not move up with the rapidity that it has over the last 3 or 4 years. And that means that more of people's income can be spent, and consumer spending will be a little bit stronger. There'll be a little bit more purchases of new cars and vehicles and the like. And so that's a plus, and to some extent it will feed on itself. Another imbalance we had was the huge trade deficit, which to some extent supplied the consumer goods that supported the consumer boom, but undermined production in this country. We are seeing something of a reverse of that. The deficit hasn't disappeared, but by my figures, it's gone from a peak of $729 billion in 2006, and last year was $421 billion. The dollar has depreciated, which gives the U.S. industry, makes U.S. companies more competitive on the world market. So again, there may be a slight bump that the economy gets from a shift away from imports and more towards domestic production. Housing, obviously, is a place where there's been a huge imbalance. I got to believe at some point it's going to change. USA Today, either today or yesterday, had a story about the rate of delinquencies slowing down. Housing prices are still falling, but they're falling at a less rapid rate than they did before. And everyone says that there is an oversupply on the market of houses. I look at the figures and I think that is exactly wrong. There is an under-demand for housing. The supply is not that great. It's just that people aren't buying what's there. But again, I have to believe at some point that is going to turn around, and when it does, housing will begin contributing to the sustained recovery as well. So I think, all things considered, the prospects for a sustained recovery, though not a really booming recovery, are not too bad. And then let me just mention in closing all the negatives that could make this not come true. First, there are higher oil prices, and thankfully they've dropped in the last couple of days. Second, there is Europe's sovereign debt crisis that is ongoing and continuing and does not seem to have closure, and which could have repercussions for the world financial system and for global confidence. Third, there is, as I think both Tom and Neil mentioned, government austerity that at all levels, the need to sort of begin to cut back in services and spending. And fourth, I would just say, is there's the climate. This last recession was a tremendously traumatic experience. It was not just an ordinary recession. And so whereas we may have had a fair amount of irrational exuberance during the boom, we may now have, to some extent, irrational pessimism in the recovery. And I think my gut feeling is that both households and corporate executives and managers are very cautious in making decisions. And if a decision is a 6 of one and half a dozen of another, they don't do it. Thank you.
I guess for the short introduction, I'll say 3 words. A word of thanks, and a word of apology, and a word of warning. First, a word of thanks.
Is this about the Red Sox?
Could be.
It's because you didn't mention Chicago.
It could be the Cubs. We'll see. First, a word of thanks. When I came to Dartmouth College, I was going to major in biochemistry, and I was going to discover a cure for cancer. Make no small plans. And I took a macroeconomics class here first, and that intrigued me. And then I took a class in money and banking with Professor Colin Campbell, who's blessed us all by joining us here this afternoon. And I fell in love with the issues in the process. And I thought, this is what's the world's about. This is what drives everything and makes the world go round. I got to get into this. So I dropped all that scientific stuff and went into the economic world, for better or worse. Word of apology. The first job I took out of college, I worked part-time at a firm called Data Resources, which was an economic forecasting, modeling, econometrics firm founded by Otto Eckstein, a Harvard, well-known at the time Harvard professor. And I mostly concluded that whole process of, and my job, I wasn't completely unqualified to do it, but my job was to forecast GM's car sales, which was my main client, General Motors, correlated in this econometric model with certain things. And I mostly decided everything I was doing was baloney. It was this whole oil prices and unemployment rates and interest rates. It was all baloney. Spend a whole lot of time agonizing about that stuff and doing three-dimensional models of it. I was wasting my time. And I decided to go more into the investment world very quickly in business school. Decided to do that. And then since then, I've basically had one full-time job since then in the venture capital and the private equity industry. And Professor Campbell, I apologize for not going into your world, but I couldn't bring myself to do it. And then the word of warning, I have very, very strong opinions about this stuff. But I also love debate, and I love people who are as aggressive in their opinions as I am, and I think better decisions get made through very open and rabid debate. So I will try to engage in a little bit that this morning. My view, and we'll see how the conversation goes. My view is we have a short-term challenge, an intermediate challenge, and a long-term challenge. Short-term challenge is we have, in my opinion, in Washington, D.C., the most anti-business administration that we've had in Washington for at least 70 years. We do not have predictability, we do not have stability, we do not have discipline. And business thrives in environments where that's the case, and we don't in Washington, D.C., and that's got to change. That's the short-term challenge. The intermediate challenge is we have a financial tumor growing in the United States created by the public sector unions. We can get into this more if we have time. I have a very strong view that in major sectors of our economy, in some of our most important economic states, we have massive resources diverted from productive use in the free economy, and also resources that could be used to help the needy and the disadvantaged in our society. And those resources are being diverted for excessive compensation, both current pay and retirement pay, to government unions. And I have very specific numbers on that I can get into later. And then third, the long-term challenge is education. My passion outside of my work and investments is education. There's nothing, in my opinion, that we do collectively that is more important than educating our children well. And the fact that we don't do it well is an abomination, completely unacceptable. And we will not be a thriving, prosperous nation until we get our education process figured out. There's no reason we can't have the greatest education system in the world, and the fact that we don't is just unacceptable. A quick statistic on that point, and this is where I probably differ from some of my fellow panelists. I saw a statistic in 1950, roughly 20% of students graduated from college. If you started in first grade, 20% got out of college with a degree. And roughly 20% of new job openings in 1950 required a college degree, so we sort of had balance, close. Today, we have 30% of our first graders graduating from college. Think about that. 30% of our first graders graduated from college, and roughly 80% of our job openings require a college degree. Okay, you know what? Big problem. And we've moved to a knowledge economy. That's where the growth is. That's where our productivity and prosperity lies, and we aren't getting there. If we don't fix our education system and focus on that challenge, we won't have the prosperity that we need going forward.
Thank you. I'm going to come back. I mean, the thoughts about the long term and changing education is obviously important, but it's not going to happen kind of quickly. What I thought I'd get you to think about a little more is that what we're seeing around the world is that the public sector's cutting, public sector employment is now falling. That has actually taken some of provided a number of jobs over the last couple of decades. But what we've actually seen, and John Haltingwang has done really good work on this, and actually shown for about the last 15 years, the big problem in the US labor market is actually there's been a secular decline in the job creation rate. So for Bruce, I'll start the question with Bruce. What can we do? I mean, you've criticized the administration. I've sort of raised the point that perhaps this is a longer run thing than that. But what can we do to get the private sector to start hiring people again?
And my answer, we have founding principles that created the greatest economy in the world has ever known in the United States. We have founding principles. Limited government, low taxes, personal freedom, and personal responsibility. Those are the founding principles of the nation. That's what created the great economy we've got. And our current policies mostly are antithetical to those principles.
Well, be specific. I mean, you get to be the person in charge. You know, what would you do? specific.
I bring stability and predictability. So we have been engaged for the last few years in creating all kinds of instability and uncertainty with massive deficit spending, massive entitlement spending, massive random. We're spending money like confetti on a very undisciplined basis. Business is scared. My fellow investors, my fellow company builders are very worried, and they're very uncertain, and they are not comfortable investing, and it takes investment to create jobs. And we have got to restore the stability and discipline and predictability in our government policy. We're not going to get there.
Can I go along the panel and take other people's views? Let's go that way. Robert, if anyone wants to respond, I'd like to try maybe take people in turn if they wouldn't mind.
I have to say I don't have a neat solution to job creation. I think that, as I said in my little talk, I think that there was a huge psychological hangover from this financial crisis and subsequent recession. And although I think I would probably agree with Mr. Rauner on some of his particular policy issues, I think it is a mistake to cast all economic commentary in a kind of political and ideological framework. A lot of these things...
Good luck with that.
Well, I try to argue against that every week in my column, but one of the reasons that there's so little understanding is that people don't describe anymore, they argue. And I have nothing against argument. Argument is a good way to sort of get at things and filter out difference. But the first obligation is to simply understand what is going on before you decide what to do about it. And so I do agree that there are certainly some policies that clearly could be changed. I mean, this business of oil drilling, I think, is one that's clear where that if the administration were more active, we would have more jobs in the Gulf, and we would be producing at some point in the future more oil than we would be by holding this stuff up. And you can go down a kind of laundry list of things, but I don't think when you added all those things up that they are the only explanation, or probably even the main explanation, for why the recovery is so slow.
Tom, how do we get the job creation rate up? Because it's in secular decline.
To answer that question directly, I'm probably not qualified to do, but what I would say, just the two ideas here that we're talking about in terms of forming jobs, we're really good within the political debate at short-term Band-Aid solutions, and it's absolutely remarkable how a wide cross-section across politics of academic literature, probably 6 to 12 hours after the policy is proposed, will show conclusively it probably won't work. And that's been one of the exercises of this crisis, whether it's cash for clunkers, this, that, or the other thing. There's one issue here which I think is interesting, and that is Neil's probably better at than I am. In the last 90 days, we've created 233,000 non-farm payrolls. That's not the issue. The issue is the hole we're in is so big that glide path leads to a fear and then the engagement of the political debate that maybe Robert and Bruce disagree on, where it's a time function, which most of my economics I go back to is looking at the x-axis and trying to figure out rates of change in that. The way I would link the two together is one of the most frightening charts on the Bloomberg is anything to do with investment in the United States of America. It is breathtaking how that's been a consistent theme across my interviews way before the crisis began. And if you look at a semi-log chart of pick your investment series, it's not pretty. Bruce is correct. It is not pretty. And so I think the solution and the dreaded medium term, I mean, the British people do this medium term thing. We really don't do that. But the medium term thing is how are we going to jumpstart investment? And I keep asking this question, and to be honest, I get a lot of silence. There's a real silence out there, and every time I circle words, do you do this? Every time I see the word hope in economics, I circle it. Every time I see the word fair, I circle it. I hate the word synergy with a passion. Paradigm, just run. Paradigm, just run. It's a scary word. And one of them that scares me is in Bruce's wheelhouse, which is innovation. Innovation is mostly sweat and sheer fear of failure, and we need to jumpstart that within a public policy of investment. And I haven't figured out a good theory on that, but to me that's the sweet spot of job creation, is we got to figure out a productive way to jumpstart investment without doing the classic pull forward from future quarters in future years. If anybody's got a good answer, I'd like to hear that. But that's fundamentally, these gentlemen are both right. But the heart of it to me is we got to jumpstart domestic investment, because GM and Ford are having no problem doing investment in China right now. You go to the Grand Hyatt in Shanghai, and I'm sorry, it says Buick out the window. That's a fact, and you can extrapolate that out as far as you want to see. So I would say that take any, I urge every student in the room, grab any semi-log chart of investment back 20 years and just gaze at the rate of change. And as Bruce is correct to say, it's frightening. And we need a concerted plan to jumpstart that to get to Danny's question about jobs.
Yeah.
I want to key onto a specific argument that Bruce made that I disagree with. But I'm prepared to be proven wrong about, and I'll explain why, which is the idea that large deficits are the problem right now. And the reason, a major reason for weak job creation is that entrepreneurs and business people are sitting around scared to death of enormous deficits. In a normal period, I can certainly understand how deficit spending would crowd out private investment. In a normal period, it pushes up bond yields, it pushes up interest rates, and that crowds out private investment that otherwise might occur. We're in a liquidity trap. There's immense global demand for U.S. Treasury bonds. Despite our large deficits, the 10-year Treasury is yielding 3.25% last time I looked. That's a very low rate by any measure. So that does not appear to be the channel through which deficit spending is allegedly impinging on job growth. Now, what Bruce is describing, and a number of people I've talked to over the last couple of years have described, is kind of a confidence effect, kind of a you're sitting there in the executive suite, and you're just not sure how all this is going to shake out, what's going to happen with the deficit, and that makes you nervous, and therefore you hold back. And that's certainly plausible. It's hard to disprove. It's hard to prove, I would argue as well, but it's hard to disprove. However, we have a natural experiment going on in this, which is the UK has embarked on a pretty aggressive fiscal tightening path. There are a lot of similarities between their economy and ours, and we'll see if job creation and growth really accelerates. If the confidence channel is that powerful, we should see it in the UK over the next couple of years.
I think Bruce is right in the sense about Keynes's animal spirits, and I think you're right too. What happened in the UK, they went into an experiment with the idea. They actually said the idea is that we're intending to do this so that we can raise confidence. From the moment they came in, they talked about the fact that the economy was bankrupt. And from that moment, consumer confidence has now collapsed to a point below where it was in the depths of the recession in 2009, and the economy is struggling. But I think Bruce is absolutely right. It certainly appears from the evidence so far from the UK that confidence and animal spirits are everything, and we don't see an awful lot of it. Yeah, please, Tom.
Just one thing, and again, to link together this disagreement between Robert and Bruce, I don't want to speak for them, is I really urge the students here to always consider the absolute and the marginal debate, because where maybe I disagree with Neil on is there's some absolute levels that are actually pretty good, capital equipment, and there's some real positives out there within. So don't tell Emerson Electric there's a slowdown. They're loving this economy. Caterpillar's loving this, thank you, to an extent, Dollar. But the marginal investment spirit that Bruce is talking about is leading, and the frustration over that is leading to the political debate that Robert's pushing against. In just one book here, Barbara Shabas on Javonian marginalia, you can't leave the school without understanding that at present it's all about the margin. And I don't know if you agree with me, but I would agree every day the media misses this. We love to look at absolute view and absolute view, where so much of what we're dealing with is marginal dynamics, but also marginal politics.
I think we should let Bruce and Robert come in again, and then we'll go to questions, I think.
I would argue very strongly it's not possible to talk about economic policy separate from politics. And I believe very strongly the Democrats, they're shrewd folks, and Rahm Emanuel's one of my dearest personal friends. They took advantage of the recession, the financial crisis to jumpstart their policy of dramatically expanding the federal government size and import in our society. And there's a role for stimulus. I'm a believer that there's stimulating on a thoughtful, disciplined, targeted, short-term basis. There's a role for stimulus to jumpstart. We're past that. The policy leaders in Washington, the honest ones, have been very clear that when their role in Washington was not. A major goal of theirs in Washington was to undo much of the Reagan administration's efforts and was to reestablish a larger, more activist federal government. And I can say from my friends, my dozens and dozens of friends around the country who are investors and company builders, that scares the bejesus out of them. And they're very worried where their tax bills are going. They're very worried about where their regulations are going. They're very worried about the cost of having a new employee coming to the company. The whole healthcare bill, which is obviously still very much up in the air, but that's a massive, massive new tax on the U.S. economy. And the cost of every new employee now is going up. It just clearly is. And if you don't need to be in the U.S. and you don't need a knowledge-based worker, you're investing outside the United States. That's where you're putting your money. And and I can name many dozens of companies who are crying for workers in the United States, but they're crying for knowledgeable, experienced, technically capable workers, and they can't find them. There's a real massive imbalance here in the United States, and it's not just about unemployment rate; it's about balance.
Well, I don't actually disagree with almost anything that he just said. I mean, I oppose the Obama healthcare thing, which I thought was bad healthcare policy and bad economic policy. And I do think that it created an enormous amount of uncertainty, particularly about the future cost of employees.
Can you bring the microphone a little higher because they can't quite hear? Yeah, please. Everybody talk into the mic.
Turn it down for me.
Okay.
Yeah.
And I do think you can go down a checklist of industries where their policies have at the margin discouraged people from taking risks and discouraged people from investing. However, if you sort of perform in your mind a hypothetical and you ask yourself, supposing none of these things had happened, where would the economy be? The economy would not be at 5% unemployment. The GDP would not be growing at an 8% annual rate. The recovery from this slump and crisis is protracted and painful, in part because it left so much damage in its wake, and having been damaged, both households and investors and corporate managers are very cautious in undertaking new commitments. And so the only point I was making was not to argue against his specific points, but was to say that we need to understand that some of these things are the consequence of our situation and not of our politics. In practice, they mingle and mix together, but we need to be aware that both these things are operative and not blame every bad thing on Obama. There are plenty of bad things to blame on him. Not blame every stupidity on the Republicans, although they're plenty stupid in some ways. But there are forces that rise above them and may be the dominant forces today, which is not, I would just conclude, is not an excuse for not trying to make better public policy. But it is just a plea to try to keep things in perspective.
I think it's probably a good moment to actually open it to the floor, because people, I think, might want to jump into this conversation. So let's, Larry, say who you are and just say who you are so that they...
Yeah, my name is Larry Kreitzer. I'm an economics professor here at Dartmouth. And I just was wondering, maybe Bruce, your comment, the way that I perceived that was really that there were two things going on. One, thank you. One was the idea which I thought that Bob and the other panelists were responding to, which had to do with sort of marginal effects and whether the policies that have been put into place to some extent are having an effect on the margin of discouraging business from hiring new workers. But I thought the more important point that you might have been touching on, Bruce, was this notion of uncertainty, and that because, Dodd-Frank, there's so many regulations yet to be written. Yep. There's a lot of uncertainty about, what is future tax policy going to be like? You know, Bush tax cuts were extended for a certain period of time, but not indefinitely. And I think that Bruce, and I'd like you can clarify your own thoughts, but that was sort of what I picked up, that you were also saying, hey, this uncertainty is really a drag, and that American business, very, very flexible, very adaptable. Let's just get a set of policies in place, and then businesses will say, fine, we can deal with this, and we'll start to hire again. But it's that uncertainty about what the world is going to look like 2 years or 4 years or 6 years from now that is really slowing down the hiring process.
Let's just take. Can we just take two? Let's just take two, and then we can take two more, and then we'll just respond to them. Yes, one over there, look, please, and then another one in the back. There's one here. Yeah, just do that, and we'll take three, and then we'll respond to them.
Hi, I'm Jonathan Petty. I'm a freshman. All four of you mentioned investment spending being low, and that being at least partially responsible for the drop in GDP. And as far as I've read, investment very strongly depends upon the real interest rate. And I was wondering what the four of you would think about the Federal Reserve attempting to push up inflationary expectations in order to push down real interest rates in order to stimulate investment spending. Would that be a good idea, or would that be too damaging to the Fed's credibility over the long run to be a worthwhile policy?
Okay, thank you. There was another question up there, and then we'll take some answers. Yeah, over there, please, chap there.
My name is David Lindahl. I'm actually a graduate of this institution about 25 years ago. And one of the reactions I had, I think maybe to Bruce's comments about that there's sort of a lack of educated, skilled, knowledgeable workforce. One of the things that's been surprising to me when I go and I'm on LinkedIn or whatever it might be, and finding the number of my peers that are now unemployed. And I never would have imagined people who had been in very, very high, upper middle class type of situations that are really hurting. And graduates of this institution and not simply just people who had just gotten out of college. And so I guess the question there is probably one more of demographics and age. Is there a handicap of workers who may have that education and knowledge, but they're in effect kind of aged themselves out, and they're expecting too much in terms of what is needed by employers right now?
Right, so three questions, one about uncertainty, one about investment spending and whether the Fed's trying to impact inflation expectations, or it wasn't quite clear why they would push inflation expectations up. But anyway, and handicap age expecting too much. So maybe start with Bruce, because you wanted to go in on uncertainty.
I think you described what I was trying to say way better than I did. This is all about stability, predictability, confidence. There's a huge psychology element in investing. And we've got an atrocious psychology right now, largely due to the federal government's lack of discipline and lack of predictability. That's a huge driver right now. That's a big part of what's dragging our economy today, in my opinion.
Perhaps I could jump in a little bit, Bruce. I mean, one of the things that I would probably characterize what we've actually seen is that in the past we underpriced risk. And that was a simple way of characterizing what happened. So now we're having to reprice it upwards. And that's going to be a long, uncertain process. So yes, I agree there's uncertainty, but maybe that uncertainty is just completely an inevitable adjustment for firms and for households and for the economy. And you're just, you're complaining about an uncertainty which is sort of inevitable.
Can I just add?
Yeah, go.
All right, so we had a giant financial crisis in which the financial sector caused a huge recession that haunts us to this day. So are you suggesting we should not have had a financial regulatory overhaul and tried to rethink how we do financial regulation? I mean, yes, it adds uncertainty, but shouldn't we try and fix some of the problems that created the situation?
All right, well, you're on a very important topic. I don't know, we got...
Yeah, you can go wherever way you like. This is capitalism. No, Bruce, go.
Professor, you're absolutely right. There is a natural process of uncertainty that would just is part of this recession, etc. That's absolutely true. The federal government is just making it way worse. And we're talking about free markets. Markets they're cyclical. Get over it. We're not going to predict it. We're not going to stop it. We're not going to control it. That's what it is.
But Bruce, aren't you seeing a new resurgence in M&A? Forget about Microsoft finally waking up from the decade's drought, but cloud computing foolishness. Are we searching for innovation? Or we're beginning to see a new percolation, aren't we?
Yes, absolutely. And despite all the challenges we've listed and the level of uncertainty, we'll be growing. We are growing, and it's just being held back significantly, in my opinion, by the federal government's policies. To your point, now, a favorite topic of mine is Dodd-Frank, whatever it is. The government.
He's read it. He's the only one.
I know. The only one.
Government regulations. The one thing I can say for sure about them is the law of unintended consequences applies. And the consequences unintended from that process are massive, in my view. And we aren't going to prevent another financial crisis in the future. It's not going to happen. And real estate markets are going to be, crash again. We're not going to predict it or prevent it. And to make our banking industry either less competitive to our international competitors or restricted and nervous about what they can be doing and should be doing, et cetera, that's just damaging the recovery even more. Now, to the point, should we require more transparency within the financial community within range? Yes. Should we streamline the process for in the future? It'll happen again. Should we streamline a process and really lay out the rules for when the federal government's going to intervene and take action when they have to, when there's a banking crisis, because there'll be another one. There will be. Don't know when. Yeah, I would say absolutely. We should set the ground rules now because Hank Paulson was going into a little bit uncharted territory. And you know what? Okay, let's learn from that. And when it happens again, let's not have it be too uncharted. Let's know what we're going to do. Frankly, what we've got to do for sure is make sure that it's not a heads bank executives and their shareholders win, tails taxpayers lose, which is a little bit of what we did. And we got to make sure that when we are forced to intervene and take action on behalf of the taxpayers of our country, that the shareholders lose in those institutions that were benefiting from the risk and some of the activities they took on. But beyond that, I think it's wrong for us to try to micromanage our financial sector. The financial sector of the U.S. economy is one of the bright spots, one of the great growth areas and one of the core elements of our competitiveness internationally, and to try to hamstring and define and restrict and micromanage our financial sector, I think is a huge mistake. Capital is flexible. You know what? When we restrict our investment banks or our lenders or our hedge funds in the United States, they're just going to go to London and Hong Kong and Singapore.
I think after the bailouts of the last couple of years, I think a lot of people would say good riddance. And if you really want to go to London,
you know what? And they might really regret that over the next 20 years.
But that emotion, as Danny and I were talking about it, I can't remember today or yesterday. The fact is, Bruce, that emotion's there.
That's politics. That's right.
It's vicious.
That's politics.
I don't think it's politics. I think it's a gut feeling, probably bigger in the United Kingdom than here. But everywhere I go, it's tangible.
Yeah.
It is a tangible emotion. It's not just Main Street, Wall Street. It's a visceral emotion.
Maybe I can ask another question here. Obviously
Should we do his real weight?
Sorry?
His real weight.
Yeah.
Gentleman up here's a question.
Yeah, go.
Yeah, just quickly. Rod McKinnon, Stanford University, Stanford Institute for Economic Policy Research, wrote a fabulous essay on your question about a year ago. And the real issue there is what's called inertia. The good news is your model, we have an experiment on somewhat with ECB right now. And the idea is, okay, we can raise rates a little bit to bring real rate in to make it more normal and non-distorted. But I've yet to speak to a single person. Maybe there's some pros in the room. I've yet to speak to a single person who believes once they get going, they'll stop. And it's a real interesting question of like, how many times will ECB go up? Just as one idea. This is, your question's out there, and it's percolating. And I haven't heard anybody really say it's a provable policy. There was something that happened at Bank of Japan. When did it happen? They raised rates 2003.
2-2. I thought it was 2-2. But
you know, it was ugly. It
right.
was really ugly. So it's a really sensitive, it's a really brilliant question, but it's also one of the most sensitive questions out there.
Go, Robert, yeah.
I understood your question a little bit differently. And I think, I can't believe you're a freshman.
Yeah,
I think you must be a PhD candidate masquerading as a freshman. As I understood your question is, should the Fed let inflation go up a little bit so the real interest rates would go down, so investment would go up because the cost of capital is lower? You know, supposing you're a freshman, really a freshman, I would say that question should be a warning to you to not take the economics you learn in the classroom too seriously. Because economists are always manipulating these things on blackboards and in computers, and they forget what happens in the real world.
There's a great...
In the real world, in the 1960s and 1970s, some of the brightest and best-known economists in the United States essentially argued a similar policy, although it was related to unemployment. And they said a little bit more inflation will be okay because it will stimulate the economy and it will reduce real wages and it will reduce unemployment. And as a result, the cost of inflation will be minimal, but the benefits from this extra push on economic growth and lower unemployment will be tangible and beneficial. Well, one thing led to another, and in 1960 we had essentially zero inflation, and by 1979, 1980 we had 13% inflation, and things were completely out of control. And I wrote a book about this, so I recommend it to all of you. The point I am making, and it's a point that Mr. Rauner made, is that the unintended consequences are enormous. And my gut feeling is if the Fed allows inflationary expectations to get out of control, they are going to rue the day, because getting them back under control and the massive amounts of uncertainty that will result if inflation is truly uncertain and it's rising, it seems to me will become a huge detriment to the economy.
I'm scared because I strongly agree with Robert. That's but look, inflation is a tool and a favorite weapon of activist big government advocates. You look around, every banana republic in the world loves inflation. It increases the power of the government, increases the levers and the way that resources can get manipulated by the government. And it's the antithesis of what we need for a healthy economy and a good, robust investment rate and a good increase in productivity. And it comes back to the whole issue of uncertainty as well.
I'm going to throw another shot across the bow here. Not least because one of the great benefits of being the Bruce Rauner professor is that you can go to the Rauner library and twist arms, and they'll hand you a thesis written by Bruce V. Rauner, May the 19th, 1978, Professor Campbell's supervisor, called Federal Reserve Control of the Money Supply Process. And I was just going to throw out 1955 to 1975. And I was just going to throw out a little comment here, which is just to set you going here. I sat in the Bank of England, and so did everybody sitting in the Fed. And actually, what our great fear was actually a fear of deflation. And I just want to leave you with a little quote. I want to ask really the question: has the fear of deflation gone? Because actually, Doug Irwin said to me the other day a nice little quote, and I'll leave. And perhaps Bruce will come to this. His quote was a Milton Friedman quote. Deflation is always and everywhere a monetary phenomenon. Deflation is always and everywhere a monetary phenomenon. I'll just start with Neil. I know you guys have been talking about inflation, but do you really believe that the fear of deflation has actually gone, given that the arguments, and you may not share them, but the arguments by the Fed and others suggest that actually the inflation we are seeing right now is merely transitory? Maybe what we should be talking about is deflation. Wrong? Right?
Last summer, I think there was some risk of heading back into the deflationary environment in the United States. Maybe not a probability, but maybe not high odds, but they were there. I think QE2, the decision last November to buy $600 billion in bonds, you can evaluate whether it succeeded or not. I think it means what you mean by succeeded. One thing it clearly did is reduce that deflation risk to a much lower level. Inflation. So on the point, whatever you think about whether they should do anything further, part of the thinking in that move was to increase inflation expectations, which had drifted down into the 1% range to try and get those expectations up toward the 2% range that's their target. So yeah, no, I'm not terribly worried about deflation now. Inflation is, I think I probably differ from Bob in the sense that we know we have a big employment problem, and to worry too much about what could potentially be an inflation problem down the road, maybe this is because I had not come of age in the 70s when that was the prevailing problem. I don't view as anyway. I see this as we have one big problem we know about unemployment. And to worry too much about a problem that could materialize down the road.
But we still don't have much money supply growth. But anyway. Tom?
There's so many ways to go here. I think there has to be a renewed respect for the disinflationists and deflationists, probably within the racket I'm in, led by David Rosenberg of Gluskin Sheff in Toronto. But there's many others. And it's really interesting to look at the goods sector versus service sector inflation, or lack thereof. If you get this transitory ballet, it's shocking how the inflation problem disappears for any wide set of reasons. But I would say, to me, the debate over this is a future debate. It's a lot of what ifs involved here, starting obviously with oil. And I find really one of the most frightening set of statistics right now to be what I've learned is stocks in use. We love to sit in Manhattan, cozy next to Bloomingdale's, and talk to people in the Midwest who are experts on farms. Because Ken and I in the morning, it's like Farm Journal. Let's talk cotton. We go to Texas Tech. And I have real trouble with the transitory idea when I've got agriculture experts talking to me about the realities of seed inventories that are out there, just as one idea. So if we get the transitory success that Chairman Bernanke is speaking about, I think it's a legitimate debate, disinflation and sectoral deflation, I guess I would call it. But pushing against that is I think, all of the ECB, some really significant non-transitory issues. One of the most important charts out there is the UN's food and agriculture chart adjusted for inflation. It's hard to pick that correct deflator, but it's there. And boy, did we have a gift the last 10 years in food, and the gifts disappeared. And I'm not so sure that's transitory. And if that's the case, particularly for the public, that disinflation, deflationary issue becomes maybe not on the market.
Right. Bob? You okay? No. Okay, let's go to questions now. The audience. We'll take them one at a time. Yeah, please. The microphone in the middle there, please. And then, yeah, right in the middle there. Yeah. Pass it over, could you? Please. Try and get a lot in.
Yeah. So, Mr. Rauner, you mentioned that, if I understood that comment correctly, that you view the economic cycle, I guess, as just something that we should accept and not do very much about. So if you could just comment on that, and also, I guess, the government's ballooning budget deficits that we've seen during this crisis, and how fast you think the government needs to get rid of that, and also your long-term view, and this is for everybody, on entitlement spending and deficit-related issues with that. Thank you.
Well, a couple of comments. We had a transformation in the U.S. economy, economic policy, in my view, in the early 80s under Ronald Reagan. And we became a much more pro-business, less regulation, more encouragement of free markets, et cetera, under Reagan. And part of it was just psychology, as much as anything, but we that, in my view, was very much the case. And it's extraordinary. I'm not as much a student of economic history as I probably should be, but I think when you look at the 25-year period from 1981 to 2005, we had two very mild recessions in a 25-year period. I don't think that's ever happened before. I don't know, but that's never happened in economic history. I know when I was in school, people would talk about the long-term proper inflation rate or whatever, and they'd also talk about a goal for unemployment to get it down to 5%. Those assumptions, Reagan policies and the policies since, pretty much threw all those away. We had a long time where unemployment was down on 4%, and no inflation, and a pretty robust economy. A lot of hiring of unskilled workers as well as skilled workers, and a pretty thriving economy, more or less, for a long, long period of time. And we have, in almost every regard, the Reagan policies are regarded as the antithesis of what should be done in DC policymakers today. And I think we're suffering some of the consequence of that right now.
Anybody want to come in on that, or should I go to Tom?
Just if you want to read about knowledge-based economy, Lundvall and Johnson is fabulous. It's Aalborg out of Denmark, and it's really the seminal work on it. Maybe many in the room have already looked through that. The entitlement thing. Neil and I are going to have a lot of gray hair when we really finally get there. And Danny and I talked about this today. They need a little victory. They just need to finally do something short, sweet, and sensible. And something obvious would be raise the retirement age on Social Security just to jumpstart. And I'm not talking about a big raise. I'm just talking about a glide path. Peter Orszag loves this phrase, glide path. And the answer is, we need a glide path to jumpstart entitlement and reform. This is Robert's sweet spot in Washington, and Neil's as well. But we're nowhere near that. I mean, wouldn't you say we've never been more distant?
I wouldn't say we've never been more distant. We're certainly not near it. I'm a little bit pessimistic about this since I've been writing about it since the late 1970s, and what discourages you about democracy is there are a lot of problems that are genuinely difficult to solve. That is to say, if you just assume political will exists and say, we need to do this, say this is improve our inner city schools, it is not easy to know exactly what to do. This is a problem, on the other hand, where it is quite obvious what you need to do. And it has been obvious that the problem exists for decades, and it has been obvious what you need to do for almost as long. You simply need to cut back some of these benefits. Probably you need to raise taxes a little bit too. But basically on the entitlement issue, we need to recognize that the world has changed. In 1935, when Social Security was passed, the average life expectancy at birth was less than 60. The life expectancy at 65, I've forgotten, I think it was like 12 years. It's now like 18 years. Many people, we should preserve a safety net. And that's what the original purpose of both Medicare and Social Security was. But instead, what we have created are retirement subsidies. We basically subsidize people to drop out of the labor force at 65 or 62. Now, some people don't have a choice, and I don't want to minimize the complexity of the social conditions, but in terms of doing something about this problem, it has been obvious, and we have evaded it simply because it was expedient politically to do so. And if you talk about uncertainty, I think this is a huge uncertainty for the future because it affects financial conditions, it affects tax rates, and it affects people's sense that we can govern. Now, the great thing is Reagan in the early 90s. Is this not working?
No, you just.
I'm technically challenged. You know, anything that wasn't invented by 1970, I can't deal with. This is a close call. I don't use PowerPoints, and anyway, I would compare what Reagan and Volcker did with inflation to the current situation in a negative sense. At the end of the 70s and the beginning of the 80s, it was the conventional wisdom of all the very smart people in society that we really could not deal with inflation. And the reason we couldn't deal with inflation is because they put through their models the economic conditions that would be required to get the current inflation down to anything that was considered long-term acceptable, which meaning 2-3% at the most. And what they got is they got a horrendous rates of unemployment for very, very long periods of time, and therefore, if you did not want to have another Great Depression, you couldn't deal with the great inflation. Well, Volcker didn't believe the models, and certainly Reagan had never heard of them. and Volcker and they believed together that that societies simply could not prosper when you had inflation rates that were at the levels that we had, which were double digits and were completely unpredictable, and were as likely to get higher as they were to get lower. And Volcker basically said, I'm going to stop this, and Reagan supported him politically. If Reagan had not supported Volcker politically, Volcker would not have been able to do what he did. And in my view, this was the single best economic policy decision probably in the last 40 or 50 years, maybe since World War II. And it had precisely the effect that Mr. Rauner suggested. It created a 25-year boom in which we had mild, very mild inflation, almost non-existent most of the time, 2 very mild short recessions, and asset booms. What he didn't mention, though, and he might not agree with, is that the underlying cause of the financial crisis was the boom that started with the Reagan-Volcker repression of inflation. And it unleashed such a prolonged period of good times that it created a feeling that we had moved into a new era, to borrow from the 1920s. And economists talked of the great moderation, that business cycles would be infrequent and mild, and asset prices boomed, and people made a lot of money, and their personal net worth went up, and people became careless and complacent, and now we know what the result of that is. And if you want to, aside from reading my book about this, which I recommend, if you want to read a good book about this, read Charlie Kindleberger's book, Manias, Crashes, and Panics, Manias,
Manias and Crashes. Yeah, that's it.
1978, and it's a pity that he didn't live to see his ideas vindicated. But in that book, he said, basically, you have a cycle. And it's a 3-part cycle. First, there's an infatuation. There's some sort of a displacement, something that happens that makes the economic outlook better. It may be the end of the war. It may be a new discovery, a new technology. It may be a series of bumper crops. It may be a change in government. In this case, it was the fall of inflation. And then you have the infatuation in which people sort of get imbibe the Kool-Aid, drink the Kool-Aid, and sort of become convinced that the world has changed. And then you have the revulsion, when people realize that the euphoria that was created in the second stage is not sustainable and is artificial, and things collapse. And that's unfortunately what happened. It's a very complicated, unsatisfying history where a good deed, a very, very good deed in my view, led to ultimately, after a long period of time, to bad results. The parallel, I'm really blabbing on, taking more time than I should, but the parallel that I would draw between the current situation and the Reagan-Volcker situation is they both realized independently that you just had to do this, even though it would be painful in the short term. Not as painful as all the economic models suggested, but painful nevertheless. Unemployment got to 10.8%. So they participated in an exercise of actual leadership, where they invited the rest of the society to follow the leaders. Today, we don't have anybody who's leading. We don't have anybody who is saying, we just need to deal with this problem, these entitlements. We know how to do it. We don't have to do it all next Tuesday morning, but we need to set out a path in which it's clear that after a certain period of time, we will have dealt with it. And I'm sorry to say the president is not doing this. The Republicans are a little closer to doing it, but they're not doing it either, and nobody is really talking about it very candidly.
Well, thank you. Lots of hands up. The gentleman there was first. I think what I'm going to do is take several quick questions if I can, because we're running out of time. So quick question, and I'll take 5 or 6, and then we'll come back.
Let me be very quick. I have appreciated very much the insightful panel, and I've listened to we should, we must, we will, so on and so forth. I didn't hear very much said about the people who hold most of the debt, Chinese for one, and what they might say we should do. Nor did I hear a comment about the global vote on the U.S. economy, which comes through the dollar, which is steadily going down, roughly 5% a year, and it continues at the moment. That is an international referendum. Nor did I hear anything about the fact that global employment is doing just fine. Jobs are being created. We know how to do it. We just don't. It just doesn't happen here. So my question really is, what can we learn from the fact that other people outside us refer to the United States as being a place that should be quarantined?
Okay, thank you. There was another hand, lady down the front. Yes, there, please. Yep. If you just pass, can we just pass you the microphone? It's behind you. Look. Thank you.
Could you talk about the increasingly unequal distribution of wealth in this country?
Okay, thank you for that one. Move on, please. Gentleman next to you, as we're there, and then we'll.
Trickle down, I think you said, was acknowledged as not an issue, or I forget exactly what the spin on it, but trickle down doesn't seem to be working in job creation. So why do people keep saying it's important?
Thank you. Let's go up to there. A couple of students up there. Could we, please? And then we'll come down here.
In addition to the job creation globally, what
can you turn the mic? Is the mic working? No, just yell then. Go on.
Oh, all right.
Go.
Sorry.
Okay.
I want to know about the aspect that the marginal cost of a job in the U.S. is substantially higher than abroad. So I want to know, even if we get the uncertainty and balance, how do we deal with that? In addition, my question is, how about we have interest rates low, but if there's not access to credit, then what good does it do?
Good. One more, just next to him.
Can you comment on China and Russia's decision recently to not use the dollar in their transactions amongst each other?
Thank you. We'll just take one more up there, and then we'll just, there, please.
It's the 9 p.m.
Or you're going to give 1 minute answers. I know it's hard. Short and sweet questions, short and sweet answers. Last one, and then we'll, please.
Is it working?
Yeah.
It seems like we're tied to numbers and constructs. And I don't hear much about the free market system in the true sense. And if we had a bubble in asset values and that country was awash in money, we would have necessarily attracted extra workers during this period, either by immigration or illegal immigration. And wouldn't the unemployment decline or the decline in employment reflect a bubble in employment? And if the workers that were attracted by the asset bubble went back home, the employment rate would be 5% instead of 10%. And to try to stimulate employment is like trying to get the housing prices to go back to where they were. In a free market, if employment was going to be readjusting for a while here to more sober considerations, people would find other places to go to get jobs, and we'd have 5% unemployment again.
Okay, thank you. Okay, so let's just jump in. 6 questions. Say what swift answers. Any one of those, take them on. Neil.
I'll take the dollar. A couple remarks about the dollar. Look, the U.S. as a share of the world economy is shrinking because the rest of the world is growing more rapidly, especially China, India, Brazil. The dollar's role within the world is likely to decline over time, and in some ways that can be a good thing. If China emerges as a competitive global economy and becomes wealthier, that can be good for everybody. I think there's a tendency to view the way I think one of the questioners did. Any change in the value of the dollar is a referendum on our national greatness. I don't buy that. The period when the dollar's declined the steepest in recent decades was in the late 80s. In 85 to 87, it dropped about 47% in the space of 2 years. That was a time of American greatness. The economy was great. We were doing very well. The time the dollars rallied the most was in the fall of 08 and early 09, when our economy was in free fall. There was a flight of money into the dollar. I think it hurts the debate when we think of movements in the dollar as a referendum on our greatness as a nation. And in fact, this kind of, as long as it remains gradual and steady, it can be part of this global rebalancing story where U.S. exporters are more competitive and we have a stronger manufacturing base and a stronger export-oriented industry in the United States.
Tom?
I'll try wealth and trickle down. I think there's a lot of simplicity about globalization, but I would suggest the major differential between the early 80s and now is this global sense. And we all know it, and we feel it every day. One of the themes we used in our media products is the new globalization. And what's really interesting is I get a lot of pushback that there isn't a new globalization. It's essentially the same as it's always been. And there's obviously the first order emotions that we knew, including in 2004, jobs going to China and all that, which has sort of drifted away. But there's a second order impact, which is all the benefits we get from globalization. I was stunned the other day to learn Emerson Electric has 54% of revenues or operating income, I can't remember which, from abroad. So it is a benefit to America, but it's obviously a benefit to selective America. And out of that, you get wealth. And the frustration I think that so many people have, and I've had really heated arguments, for example, with Alan Meltzer at Carnegie Mellon about this, is a sense of aggregate. And that we love to talk about the whole nation, we love to talk about the whole of society, where it's, I would suggest, remarkably compartmentalized, whether it's 4 blocks in New York City, or it's an MSA or a region that's booming, or the Midwest now booming. And so there is, on a sectoral basis, wealth being created in the United States, and there's wide bodies that are being left out. And the challenge we have forward is how do we reinvigorate at the margin the wealth have-nots or the income have-nots, which is arguably 2 separate things, and move them forward. And it's going to be a whole new calculus, I would suggest, because of this globalization in goods and treated differently in goods and service sector. But this, I guess the single message I have on this is there is a lot of wealth being created, and there are a lot of people moving up with it in a conventional Republican Party format, if you will. Go to the Republican convention and you're going to hear a lot about that. Pushing against that is this remarkable silence on an undereducated part of America that's not taking part in that wealth creation. And that's, I'm not even sure it's a debate for 2012. We've got to get another 4 million jobs created before we maybe engage that debate. The single best paper I've seen on this in 4 years is Ned Phelps at the Bank of International Settlements 2 or 3 summers ago. It is a textbook piece on innovation and how we need to find that next wave away from CDO squared and financial manipulation and much more to what Bruce is talking about, which is venture capital. We need to find that innovation and then the marginal improvement in the have-nots towards the wealth that you desire. And right now, it's not there.
Bruce?
Let me respond on the one about the growing disparity between in incomes. I think that's probably the most sensitive, one of the biggest challenges we've got going forward. That trend has been going on for a long time. I would argue that the problem and the solution is in education. The standard political response is no, but it's unionization, it's redistribution through tax policy and government programs and whatever, and that can narrow some of the income gap to a marginal degree. But I would argue the cost in terms of overall wealth and prosperity and growth is more than offsets those types of policies. And the true long-term answer to income growth is productivity growth, and productivity growth comes from education and training. And the fact that we're doing it very poorly is a core part of the problem. And this is many decades. This is not. Right. We have moved in the last 40 years more and more every year to a knowledge-based economy. We don't, and that's not. We're not reversing that. And as the rest of the world has caught up with us in their manufacturing and the low skill productivity. They're low-skilled workers. They're forced down the low-skill incomes in the United States, and they're taking a lot of our jobs. And a lot of American companies are investing over there rather than here for those reasons. And that's not going to. We can complain about it. We can try to tax more or redistribute income or whatever, or encourage more unionization, or raise the another standard one. Let's raise the minimum wage. Those are all in a lot of ways counterproductive, in my opinion. And it's really about education.
I'm going to very close to the end, but I want to just give a moment for a couple of students, very quick questions if they want to come in, and then we'll finish. So any students, quick. You're not a student. Sorry. I do notice. Here's one, please. You might want to be, but...
Did you notice that all the old people walked out of the room the moment you said that?
I know.
I know,
but I just want to give them a quick. We're nearly there, but I'll give you a quick go. Go.
On visceral emotions, where do you see those going in the future? Main Street versus Wall Street? Could we see another stab in the back type thing as we saw in Germany, or more in Greece?
Okay, another one, and then another student. Anyone? Any more for any more? Oh, there you are. Yeah. Hello. Can you? We're not hearing the mic. Just click it, kick it. Okay. Speak or shout.
I'm in Professor Blanchflower's class. We've been talking a lot about bank lending and the availability of credit to people and companies. And so, for Mr. Rauner, I'd be interested in hearing your view as a private equity investor and how you see banks going forward. Do you think that corporate balance sheets for banks and savings and loans institutions in particular have kind of firmed up? And do you think they're going to start lending?
A quick answer
Thank you.
is yes. The lending environment, frankly, in our world, has probably come back a little more aggressively and a little faster than I might have predicted 18 months ago. But again, there's a case of haves and have-nots. Lenders, they're more cautious around lending to small business, unsophisticated borrowers, et cetera, and they're gravitating to what they perceive to be quality. But I'm seeing lenders take risks that I think are getting close to excessive again already in many of the transactions that we're participating in.
Main Street against Wall Street, or are we done? Robert?
I think it's interesting that Wall Street seems to have survived this without as much damage as you might have suspected. I think it's really part of this general inequality issue. And I think that politically, inequality does not, measured inequality, statistical inequality, does not really matter when most people feel they're getting ahead. That is, they may resent a little bit the fact that somebody made billions or multi-millions or whatever, but if their incomes are going up and they feel their life is getting better, they're not really furious about it. When things turn bad, and when their incomes are going down, or when they have more insecurity, they get very upset about it, even if statistically it turned out in retrospect that income or wealth inequality was declining. And I think it actually declined in the Great Depression. I'd have to go back and check on that. And you could see why, because a lot of the wealthy lost a lot of wealth, and the people who didn't have wealth didn't lose that much. But my point is it really depends on the circumstances. And the disparities that exist will be most offensive in periods when a lot of people feel vulnerable for one reason or another.
Well, I'd like to thank everybody for coming and especially thank the panelists. Thank you.